folks, Fidelity, Charles Schwab, they offer as a initial maybe 1 to 5 phone calls, depending on which service you sign up with, they'll offer some guidance for some time. So you should take advantage of that, right? And today is informational. I'm not a financial advisor, so I'm not actually licensed to tell you to pick and buy stocks. I am for the venture space, but for the, I can't tell you. I can suggest as a free conversation, you should always do your homework first, right? What you won't get, awesome graphics, because I'm not a graphic interface dude. I'm just not that guy. So you're going to see it's going to be a pretty plain. We're just going to get to the nuts and bolts of things. So it's not going to be pretty, the slide deck, but it should have information for you. Extensive accounting. We're not going to get into balance sheets, net income, and income statements. That's very important, but I think we're trying to keep this around more accessible to a broader audience. If we want to do a 300, 400 level class of this at some point, or a session of this, happy to do so. But I think for today's purpose, we'll keep it around just kind of intermediate down to intro. So tee up. This next section is going to be kind of boring. All right, so a few slides. Just got to tee it up so you know what we're talking about later. Once we get through these definitions, the next slides, hopefully it'll be kind of fun. And then I'll get some questions ready regarding the slides I'm going to put up, because then Radia will pop in with your questions and I'll answer them the best I can. Why are we here? And why now is a great time to invest is where we're going eventually. So some governments, right, underreacted to save face due to this whole coronavirus. And now we're overacting to save power, a lot of these governments, right? So in the investment landscape, in the foreseeable future, it's going to be pretty choppy. You're going to have a lot of volatility. Volatility just means swings in the stock market. And at another time, we could talk about how the stock market isn't the economy. Economy is the big brother. Stock market is just a tiny sliver of it, right? But the volatility in the stock market, which is our focus today, is going to be extensive, right? So eventually you're going to need to see some sort of psychological bottom in the public markets, right? So consumers, us, investors, they're going to need to see, hey, we are kind of getting the grasp of this new way of living. If it's a short time frame or a longer time frame, we're getting used to it, we're adjusting. We know now how to move forward. You're going to need to see that. Then you'll have to see it in the private markets. And this usually it could take 6 to 9 months, maybe 12 months for both of these bottoms to occur. Let's give an example of the financial crisis of 2008. So there was initially in the stock market, a drawdown of around 30%, right? And the market stabilized for 2 months and people then thought we were clear. They started just pouring money in, and then more bad news came because of everything that was happening, and it fell off another 50%. So then the rally, which went on to an upward trajectory, that happened 9 months later after it initially began. So you similarly expect volatility in 2020, right? It's going to be that way. But there are pros and cons. You can make money in a market like this. And that's what we're all here for. So leverage volatility. This is the best graphic you're going to get from me. I got it from Google somewhere. And so leverage volatility advantage. Just a quick thing. As I mentioned, I grew up in Northwest Chicago and I'm born and raised there. I lived downtown Chicago before I moved here to New York. Bulls and Bears. I love that. That's our, that's how they describe the stock market. That's my favorite teams too. So the bull, just to give you a quick thing as an educational thing, the reason it's called a bear market when it's going down, simple fact, fun fact, is because bears, when they strike out, they strike down with their paws. With a bull, when they charge someone, their steers are up. That's all it is. That's all it is. So that's, if you ever hear bull and bear market, that's why. Okay, why? Why it's a good time to invest in the stock market right now. So we've had 5 recessions the past 50 years, and we've always eventually rebounded well. You just need certainty in the market. So we know what caused this crash. It was a health crisis, right? Initially began in Asia, migrated across the world. It became a financial crisis. Now, usually, so it was a supply issue initially. So if you take, for example, like there was a toy company I remember seeing on Bloomberg or CNBC, one of them, that was saying back in January, the first week of January, saying we can't get toys because they're not being manufactured in China because China manufacturing is shut down. So it was a supply issue. They couldn't get the things, they couldn't get their inventory to sell to us here or across the world. Now it's become a demand issue because we're saying stay home, don't go out and consume. We get groceries, we're getting the essential things, right? So that's where we're at right now. So usually to spur an economy like this, you want to get past it, to spur it back up and get economy rolling again. Once there's certainty, is consumers, us, getting in the market to buy things again, demand. But this is kind of different because we're saying you have to stay home And that's how this is a very unique situation. So we're gonna have to kind of figure this all out together. This has never been, there hasn't been something like this in a long time. As 100 years of Spanish flu, that would be the closest at this clip. I would say there've been other SARS and MARS and all that, but at this clip, there's never been something like this. And the economy is much different now than it was 100 years ago. All right, in a couple of slides, get some questions ready, because in a couple of slides, we may ask you for some. Markets are going to react to medical news right now more than anything. So we're thinking about a vaccine 12 to 18 months away, right? When we're going to feel comfortable, like the typical flu that we're used to getting vaccines for every year. It'll be 12 to 18 months before that happens. Hopefully sooner, we don't know. And medicines, there might be a Tamiflu equivalent, which is for like the regular flu, something that suppresses the outcomes or suppresses the symptoms of this current coronavirus, but that hasn't been on market yet. We might get that by September, October, hopefully, maybe sooner. The great thing is you have a lot of brilliant minds across the world working on a solution right now. So hopefully, we've never been in a place like this. As long as we share information, which we don't know if it's going to happen, but we're in the world together, so let's see what we can do. Companies will then see a sustained upward trajectory. That's when you know that things will start looking good once you really have that vaccine in place, right? But how do you get through these next year and a half? How do you do that? Annual returns, this is very general, right? It's different in every year, but just an average various investment vehicle returns that you get in stock markets, which will be our focus today, is 10%. Real estate hovers between 9.5% to 11.5%. If it's residential, slightly higher, commercial, slightly less. REITs, which are real estate investment trusts, which you can invest in various residential properties across through the stock exchange in a fund, in an exchange. Treasury bonds, 5 to 7%, CDs, or 1 to 2%, generally. Savings account, less than 0.5%, it's a waste of time. I'm kidding. If you need to keep something there for the time being, absolutely a good place to store money for a short time frame if you can get into something a little stronger. Okay, this is not adjusted for 1 to 2% inflation, right? So keep that in mind. Okay, the Dow Jones, we're going to go through this quickly because this is going to be very daunting. I just want to say the Dow Jones, what that is. The Dow Jones is basically it's a price weighted index, and you keep hearing numbers thrown out there, 30,000, 24,000, 20,000. What is that? Why are they talking about it? Just for you to know, so then you can then benchmark things against it and see how things are moving in the market. The Dow Jones is basically US-centric. It has 30 blue chip stocks, companies that have been around for a long time that have sustained success. And they take their stock price, add them up, and they use some sort of algorithmic averaging of that, and then they get a number. So this thing started late 1800s, right? And it took the Dow, which is the gentleman's name, Charles Dow, 103 years to hit its first 10,000 at the 10,000 mark, right? And then it did fall off from there. And then I think at 2010, it started staying above that 10,000 mark, but it first hit it 10 years prior. February 20, we were at 30,000. March 20 of this year, we fell off to 19,000, less than 19,000. So you can see it took us 103 years to get the first 10K. To fall off from our peak, it took less than a month fall off 10K at our peak. So it's a volatile market. Bull market, as we said, it's a 20% rise in the stock market. That's a general assumption. Bear market is the opposite, 20% decline in the stock market. So the longest running bull market, we've all heard that across TV, news, and everything. The reason you've been hearing that since 2009, March, when the Dow was around 7,000, until its recent fall, it had an upward trajectory with no period at all of a 20% decline. So that's a good thing, right? In the 300, 400 class, we can talk about why, if it's a good or not a great thing. Okay, we'll talk about this. Okay, so here, invest. Pump the brakes or step on the gas. You should pump brakes and don't invest if you have a short time horizon. If you have job insecurity and you're risk averse, right? You should step on the gas, do invest now, if none of the above apply. If you have a longer time horizon, 8 to 10 years, job security, have 15 months, let's say roughly, of savings, 12 to 15 months of savings to cover your costs, your day-to-day living for your family. Current portfolio, you should review it and diversify from it because stocks right now are on sale compared to what they were previously. I think you might get some more clips as to some better entry points, all right? And so that's a great thing. So ready, and just get ready for this volatility ride because it's going to be up, down day to day. Don't let that scare you. It's daunting, but it's a good thing to follow it just to get an idea as to what happens with news. All right, the setup. Stock market investing. So you should start investing in stocks now if it's the right choice for you. It's never too early, too late. 20, 15, I want to get my young guys 8 or 9, I don't know how, I think by 10, I want to give him an account and I want him to get that up to a certain amount of money by the time he gets to college. I want to equip him with the knowledge to get there. So 20, 30. So my kid's less than, he's like 9, but like I'm saying 20, 30, 50, 60. If you're not investing right now, it's okay. Get in now and find the right point for you, and you'll still have some upside to it. Okay. Embrace a few easy concepts after today and feel confident about investing. Before we go through the 5 stock market tips, there's a general formula that this is going to be different for everyone. It's your personal taste, your risk profile personally, but take the number 110, subtract your age, and that's the percentage of your total assets you should have in stocks. General rule, very general rule, right? And then you get into like, okay, so for a 40-year-old, you should have 70%. So 110 minus 40, 70% of your money in stocks. The rest should be in bonds and cash. We're going to go through that in some graphs in a second. All right, this is the best you get, again, graph-wise. Portfolio risk, low to high risk, right? You see here, conservative, lower risk, high risk is very aggressive. That's going to be heavy on the stock side. As you go here, as you go down this, it's more bonds and cash, holdings in cash versus stocks, right? Portfolio risk. Here's a simple pyramid. Stocks on top, cash on the bottom. In given markets, in another 300, 400 level class, we'll talk about maybe having cash in hand isn't great because, if you're just holding cash and you have inflation going up at a certain point, you're actually losing money. So we'll talk about that in the 400 class, 300 class the next time. So portfolio risk, detailed pyramid. It goes up here. So now we're going a little more. You have real estate in here, some high income bonds here in the middle, government bonds, cash, obviously down here. As you go up, options, futures, stock, all stock related activity goes up the thing. It gets more risky as you go on, right? So here's an example of a conservative portfolio. Again, this is just a generalized assumption from Investopedia. You should have around 75% of your money in fixed income. That's bonds and bond equivalents. Cash, 5 to 15%, maybe 15 to 20% in stocks or equities. So the reason there's these numbers, a range, is because wherever you are in that risk profile, or wherever you are in your time of life, a career cycle, life cycle, if you'll need money, if your house purchase or whatever you have coming up, then you can adjust accordingly depending on who you are, right? So depending on your tastes. So what is four traits of a conservative portfolio? They're cautious, maybe a first-time investor. A focus is portfolio stability, capital preservation. The time horizon, you need investment money. You need your money in less than 5 years, right? So you need to draw on it and pull on it. So then you should keep your things in safer investments where you have more flexibility, liquidity, they call that. Portfolio, larger percent of cash and bonds in your investment, right? So that you should keep it more. Cash is the most liquid form and it's a liquid asset, right? Because you have it in your hands whenever you need it. Aggressive portfolio, higher risk profile. Okay, all right, bear with me, it's gonna get better in a little bit. All right, 80 to 100% in equity, stocks, 0 to 10% cash, fixed income is there. Aggressive, what are there? Experienced investor. I'd probably fall into this, but when I first started, I had no idea, and I was asking questions. I felt silly asking certain questions of certain people that were very high profile, but I asked them because I didn't know, and now I'm at a point where I can help others kind of get along. So experienced investors, focus, above average portfolio appreciation, tolerate fluctuation in their value of investments. If I know that I don't need to touch that money, so if Apple stock falls off $100 today, I don't need that money for a while, so I can wait for it to come back up if I think it's going to go up, which I do, right? That kind of thing. Seeking high return expectations, your time horizon, don't need the money for 10 to 15 years. Portfolio, primarily investments in equities. Good time to invest, boom. If you're asking, yes, right? If you're ready and all the other things apply to you above, yes. All right, so this is where Radia comes back in. So just from here, before we get onto the stock market tips, any questions first off?
Yes, Sahara had a question. Sahara, are you able to unmute yourself? If not, I could try to unmute you. Okay, okay, go ahead, Sahara.
Hi, Sahara. I think she's still muted.
Yeah, I'm unmuting her. She might be unmuted on her side. Sahara, try to unmute yourself on your side if possible.
It was answered. Thank you.
Oh, good.
Okay, good. Probably by
Thank
Radia,
you.
probably not by me, but that's cool. We'll go with it. Any other
Garth
questions?
Garth has a question. He said, stocks are usually for long-term investment, 5-year projections. What would you recommend for folks who are looking to see earlier returns, like under 2 years?
So then you'd probably go on that lower risk profile. So look, again, check with your financial advisors. Don't take this as gospel, right? So you can go and then on the lower graph here, let's go up to that graph right here, boom, right here. Hover in this area, right? Some bonds have longer terms on them, like you have to put money and it's given away and then they give you a return on that. That could be 3, 5, 4 years. CDs, you're not getting that much on it right now, but that's, if you're limited and can't invest in stocks, these are alternatives for you. And now with interest rates so low, all of these things are built on interest rates, right? So what the bank gets a loan money at, they're going to give you that kind of interest into your savings as well. So you're not going to get much. Don't expect a lot here on the lower you go on this graph. But that's one thing. If you're an experienced investor, if you're comfortable, you've been doing it for a while and you feel very comfortable, you can do it in the stock market. But that's, if you have everything else, all the things that we discussed earlier, like you have those tucked away and you feel secure. Hope that answers the question.
We have, what is your advice as far as researching stocks? How can one research stocks to invest in?
Great question. So I was going to get to this in the next section too. So follow your interests, right? And you're going to see me, this is going to come up in a slide. Actually, can we earmark that for later? Because that's going to come up.
Yeah. We'll save it.
Okay, cool.
D, hold on. Your question's coming.
Cool.
What are the benefits of investing in bonds? And that was from Candace.
There are some great. So I'll be the first to tell you, I'm not a great resource for bond trading. I'm a pure stock equity, and I tap into other resources when I can. But there are benefits to it. You get a kind of in a sense, a guaranteed return. You know what it's going to be, right? And as long as it's beating inflation and everything else going on, and it's tax-free many times, often, or tax breaks. So there's great benefit to it, right? And equities, if you're trading, in stocks, which same thing as equities, if you're trading, if you capture gains, like if I buy it today, sell it in 3 months, I have to pay my current income bracket tax rate on any of their gains, right? So let's say let's make it simple. You're a 20% return, 20% tax bracket. Let's put you anyone there as a general rule. You buy something for 100, you sell it 120. You made $20, but you're in a tax bracket, so that $20 is going to be taxed at 20%. So $4, you actually made 16 versus 20. That's a bad example, but it's a simple one. The other one with the bonds that somebody mentioned asked for, you do not get taxed at that rate. It's a better rate, or sometimes are tax free. If you back to the stock thing, if you sell it after a year, then it hits that capital gains tax rate. The other tax rate, which is like 15%, something like that. So it's a little less.
Okay. And then are there any platforms that you recommend to start for new people starting to invest?
Yeah, so you pick your poison. So they're all good. So I'm in Fidelity. I've had experience with Fidelity, E-Trade, and Scottrade, I think. And I'm in a few of them. So like Charles Schwab, any of them, and you can go on and they're great resources. As I mentioned earlier, you can just set up an account, start speaking with someone because they want money. I'll tell you one thing, a way a lot of these companies make money, you know how it went to 0% commission right now is because in a lot of them, you can trade for free basically. It's because they take whatever money you put into there and they give that out as loans overnight back to each other behind the scenes. And so, they're open to you being in. You don't have to have a ton of money to put in right away. The more you have, the better. But you don't have to have a lot to put in right away. You may even just give them a cold call and say, look, I'm looking, I'm interested. Answer these questions for me. Get free advice from them. Why not? So E-Trade, Scottrade, Fidelity, Charles Schwab, they're all great. Charles Schwab's the behemoth in the group. You know, I know a lot of people are talking about that newer platform, Robinhood, which is great. I don't think you get any of the information there. You just get to trade. So that's probably not the best for someone who's beginning. It's beginning because you can buy fractional shares, but I think you can't get the advice, which is why they were cheaper initially. Now you can get all that free commissions at the big dogs. So why not go there?
Do you recommend any books, any good investing books for new investors?
A ton. So what I'll do just to be safe for people's time, I'll put a list of them on my website. How about that? Or I'll send them to you, Knit Ready, and you can send it out to everybody. We can do either way. I'll send you a list, podcasts, news, radio shows. I watch a lot of Bloomberg if I want to really listen in, or CNBC if I want it in the background because it's more of an accessible. So we'll talk about that in a little bit.
Okay, and then one last question, and we'll move on. You mentioned Apple, which is still pretty high. Would you recommend investing in that at this point?
So here, I can't give you legally. I don't think I can give you that kind of advice, but I like it here. So okay, I think it's going to come down a little bit. I think because the market's going to follow. So here, I'm just going to put out some general information so I don't get arrested. You don't even know the brown dude getting arrested right now. So,
I know, right?
So yes, I love Apple. It's the reason I get to supersize. If I ever did go to McDonald's, which I don't, I would supersize. It's the reason I get to because I like Apple. Apple's done well in my portfolio, and I love that stock, and I tout it everywhere I get. Now, will it come down again? I think it will. I mean, why not? But is it going to be around 10 years from now? You should always ask yourself, will this company be around 10 years from now? And how are they evolving? I think Walmart is another company. We don't think of it as in the same plethora as like a Macy's or Saks or whatever, but they've evolved with the times. The digital delivery, the e-commerce play is huge for them. So these are the kind of companies, who's going to be around 10 years from now? And who's set up for the next 5-10 years? Those are the kind of companies you want to invest in. And look, they're sitting on a ton of cash. Apple, I think it's around, and they just increased their dividend, which they're probably less than 1% of companies. A lot of them are taking away their dividend. So yeah, whoever that is, we can talk offline. I'm happy to. I like Apple, and I can lay it out in detail why I like them.
Wonderful. Okay. Let's proceed.
Okay. All right. So 5 stock market tips, and this is where we're going to get into some of those things. So hey, just keep it simple. You're going to pick companies, not ticker symbols. We're going to go through these line by line. Reduce anxiety by creating a stock checklist and build up your stock positions gradually. Don't go all in. Don't put all your money in today, do it over time, and avoid over trading. We'll go through these slide by slide. All right, keep it simple. So check your emotions at the door because you want to focus on the long term. You're not just trying to, unless you're a day trader, which you shouldn't be, don't do that. Let's just start there. You're not trying to buy something today and sell it tomorrow. Unless you're experienced, don't even mess with that space. You're never going to get the bottom of the market. You're never going to get the top. There's only one person on either side of that cliff that gets that. Everyone else feels, but you can't. You have to get used to that. So check your emotion at the door. Don't keep looking at the daily stock price because then you're going to get caught up. Oh, I bought Apple, for example, at I think it's like 293 yesterday, 290-ish, right? High 290s. And then it dips to 285. You're going to think, oh, I could have bought it cheaper. Don't worry about that. You got a great company at a good price. It's probably going to go up, right? Because if you check things every day, then it's going to lead to irrational decisions, right? And you want to stick to your long-term strategy. So we're going to get into that. And we'll go by detail on any of these that you need to at the tail end. So you're picking companies and talks, not ticker symbols. What do I mean by that? You want to invest in companies. You want to eventually, we're not going to talk about these today, but balance sheets, cash on hand, low debt, right? Apple's a good example. Walmart's a pretty good example. Disney, we can talk about, they took on a lot of debt to buy, like, let's say Marvel series, which they made a ton of money on. And there are all these deals they've been doing with Fox and all that. So they've done some incredible deals. Now with everything shut down, I think they're positioned once things open up to be an incredible company, right? So you want to look at companies like that. So Apple and Walmart would be better examples. They have cash on hand, they have balance sheets that are pretty solid. Amazon's an interesting company. You want to look at companies you understand and enjoy. So I love tech. I look at Amazon, Apple, Netflix, it's cool. It's high. It's 400 something. Now, Google, Facebook is another one. they're questionable. Some of them may have questionable practices, right? They, the privacy matters and all that. So you have to, that's your own moral decision. But some of these types of companies are fantastic if you dig down to them. If I like cars, I would look at GM, Ford, Tesla. I've owned all three of those at some point. I own Tesla now, and it's a weird stock, but I'm just doing it just to have fun with that because I don't trust. I love Elon, but you can't trust what he's doing because he's saying some things in the market right now. But he's brilliant. So look at things that you understand. The reason I say the things that you understand and enjoy is because you'll have then an appreciation to read up and absorb as much information about those things. If you, I'm assuming a lot of our folks are in the media and entertainment space because that's the name profile. So you may want to read up on what's Disney doing, what's Comcast doing to counter that, who's partnering with Hulu, what's going on there. You want to know what's happening now, a year from now, 2 years from now, 5 years from now. Just keep reading up on it. You'll have an interest. If you told me, my wife's in healthcare, I used to be, I'm no longer. That space doesn't interest me as much, so I don't read up on it as much as she might. Or some of my friends, I have a dear friend who's looking to launch something in that space. He'll know a lot more about that space than I would. So you're going to be prone to look up and review things about the industries you like. Remember, you're buying a business, not just a ticker symbol. People just look at AAPL, Apple, got to get in. Don't worry about that. Look at the business behind it so you can see if it's a good play long term. Okay, reduce anxiety, right? You have to create a stock checklist so you then check it. So when you're in, let's say you get in every week and then it's down or it's up a bit, you should have a benchmark. I'm going to buy it here and I'm going to sell it here. If you get above or below those, depending on what you're trying to do, you win, right? So get comfortable with the balance sheet. Eventually, how does a company make money? How do they do that? How are they positioned for growth? What are some risk factors around them, right? So right now, Disney, I think it's a brilliant company. I thought Netflix owned the last 10 years. Disney was going to own the next 10 years. That was my play before this whole thing began. They've had to shut down everything. A lot of their products, you have to be like the parks. You have to be near each other to do that. But I love Disney as a long-term play once this whole thing gets sorted out. But the risks involved with the Disney is because they have to shut down their parks, right? So they had diversified revenue stream, diversified portfolios. They have, the digital play, linear, the parks, merchandise. But then right now, a lot of that is brought in, right? Who's not suffering as much right now? Walmart, Amazon, right? Different risks came at them and they get to pop up to the top. They're almost becoming too big to fail, which is another question. So how does it use its free cash flow if they get it in? So I crap on some airline industry all the time, right? They just got a bailout, and I did this on our podcast too. Each of them was earning $3 to $4 to $5 billion a year in revenues, but they put that all back into buying their own stock, which would get their stock price up, right? That's cool, I get it, because then it pads the pockets of the executives, but then it's not great when you're asking for a bailout when everything hits the fan. It's not good. Apple, Disney, to a certain extent, Amazon, they all have a lot of cash on hand, so they can weather this storm. They can pay salaries for everyone if they're shut down for a year or two. Not the wisest choice probably, but they can do that, right? So you want to look at when they face certain risks, how do they mitigate them and how can they arise past them? Is the stock cheap relative to its peers, right? You want to look at these kind of things and you set your criteria, stick to that plan and do periodic checks, and that'll keep you honest with yourself, because sometimes we get all emotional about things and we want to do it. I've done it. Okay. If you have $10,000 to invest right now, my suggestion would be you buy stocks $1,000 to $2,000 at a time. You could have less than this, you could have more than this. Let's just keep it simple, 10K. One popular method of many is dollar cost averaging. At set time intervals, let's say once a month, once every 2 months, once every quarter, you buy into a certain stock. Let's say you want to get into Apple, Walmart, and Apple, Walmart. Let's do another play like Tesla. All right. Let's not do Tesla. Let's do GM or something like that. So those three, right? I love Tesla. I mean, I like Elon, though. He's great, but he's just crazy. You want to get into those three. You'll say you want to do, for the next year, I have $10,000, $12,000. Let's say 12,000, make it easy. Every month, I'm going to put in $1,000 and buy as many shares of those and whatever percentage of those I want and buy that. And then the next month, and that way, because let's say, as you know, the market goes up and down like this, right? So, today, if I buy it today, so if you had bought things in January, February, March, I'm sure you bought them at lower price points. So they call it dollar cost averaging because over time it averages out and you're getting a lower price point. If it's going up over time, you're averaged out by what you bought at lower, because they fluctuate daily, hourly, and by the minute, right? So that's one thing. Okay, so you're not a day trader, so avoid over trading. I'll do some of this sometimes, but it's not smart. It's not smart at all, right? So you try to buy a stock that you believe in, a company that you think is positioned well against its peers, for the market and for the future, and you let it simmer. Just hang on to it. You've done your research. You keep doing your research, review it every so often, and if as long as it stays in line with your checklist and you're all solid there, stick with it. I think it makes sense. And focus only on your returns. Don't worry about someone might say, if anyone does that at water cools anymore, but whatever, at the swimming pool, wherever you are hanging on a bar or something, hey, I got 20% return on this stock. Don't worry about it. You look at what you're doing and what's good for your needs. So don't worry about everyone else. I've done it too. I'm like, hey, someone tried to tell me they got a return on this. I said, I got this return, whatever, who cares? But so just compare yourself to what you're trying to do and when you got it, because we all got into the stock at different times. We all have different goals. And you just want to aim to beat at least 8%. 8% is the S&P returns that every year on a historical basis. You want to beat that, all right? Otherwise, you may as well just kept it under your couch or something like that. Okay, first, questions. We're going to talk about startups after this. And any questions?
Yes, so I have a question from Crystal. She says, if you're employed by a company like Disney, Fox, and you were given shares by the employer, but you want to increase your ownership, do companies give employees discounts on additional shares that you purchase?
So that's on a per company basis. So you have to check with the folks there. I can't answer that for every company. Some companies do. And I think the higher up the tier you go, the better your options in that play. So that's something you're gonna have to be specific. Yeah, but if to answer yes or no, it depends on where you are, and yes, in some cases.
Okay. And she should inquire at her company, correct?
Yeah, that's the place you would, because they said that. That's an HR thing.
Mm-hmm. Okay, and David asks, why is it not a good idea to invest in IPOs?
Who said that? I didn't say that. Okay, no, I think where this person's going. So, okay, David?
Yeah.
Okay, it's a good question. It's a good question. Let's just say, let's see what happened last year. IPOs had, I'm going to keep this PC. They had a horrible year last year, right? But generally, SaaS companies, software as a service companies, those companies, their returns were pretty decent, like 40, 50% on average. You took the whole year of 2019. Uber, we know what happened to them. We know Airbnb got delayed because of everything that was happening. If they had IPO'd 2-3 years ago, Airbnb, they would have killed it, but they waited too long. But they were waiting for their own reasons, but now they're not even being utilized. So Uber, who else? I think Lyft, who else came out? Lyft came first, Uber, who else? There's another big one, I can't think of it. Somebody will shout it to me, somebody will text me. But the reason is because when something comes to market, generally, this is a general term, not always, people, they have their first access to it, and institutional investors get in and just buy a ton of it, and they ride the price up. Usually a day or two later, 3 weeks later or something, you can get it at 10% discount, meaning it's fallen off that price. So that might be what David is referring to, why it's not a good idea. On some things, it's okay. I think Uber fell off in its IPO. Facebook fell off in its IPO. I know, I was a victim of it. And I had to hold on to it because they had to get their HTML5 thing for mobile platforms for mobile platform advertising in play. So whenever they IPO'd, I didn't lose money. I just hung on to it, and then it came back up, and then I killed it. So it was good.
Okay. Yola is asking, how do you access the balance sheet of a company?
All this is public. So if it's a public company, it's all publicly out there. So you can, oh my God, why am I not? Here, how about this? The one thing you can do is let's just say go into E-Trade, and you can access a lot of the things there. Oh my God, why can't I think of the term? It's going to come to me. There's one place that has them. It's a depository. It's online, so you can get them. It'll come to me, and I'll send you a link. You can look up anything. And a simple way of doing it, just go to Google and just type in Apple stock or Amazon stock, and it'll list its current price and a ton of information, all the news around it today. You can go back as far as you want, and you can access everything right there. But I'll send you the link where there's one place you can there's a depository online.
Okay, great. And then can you also add apps to your recommended readings and websites and things like that?
Great question. Yep, I'll do that. Let me write a note. Let me do that.
Okay.
There's great free resources. You don't need to pay for a lot of it. Some people so if you're in a banking setting, they have access to Bloomberg terminals, so you have access to a lot more. Mm-hmm. But for us on the consumer side, we're called the retail sector. We're 30% of the stock market. Institutional, who are hedge funds and all those people in banks, they're the 70% roughly. We have access to a lot of information as well free information that you can make a lot of money with.
Nice. And Mia had a tip. Mia said TradeStation is a great platform to practice. You can use the site app to fake trade to see how you would do until you're ready to start trading with your real money.
Who said that?
Mia, and we love
Mia?
Mia. Mia's so smart.
I don't know you, but hugs to you, because I was just talking, because I want to set this up for my kid, and I have an uncle and my cousin who we're going to do this together, and I want them to just try it with paper trades. So TradeStation, thank you. I was looking for something for them, so thank you, appreciate it.
Okay, yep, that's all our questions right now.
Okay, all right, cool. All right, boom. And startups, if people are interested in this, you can, Radia, if you see, you can tell Radia if you're not interested, and we can pop out of this. So let's talk startups, right? Economic recession, how is it going to affect this space, and how you can actually poke this up the ladder, and how it's going to affect the stock market and all that too. Investing generally moves from equity, from stocks into fixed income during these downtrends, which will be on, stocks will be on sale right now, right? So VC, venture cap, people like myself, like limited partners, we become very selective as to who we want to partner with, who we want to invest with or develop a relationship with as a company to take them farther. And we'll give smaller check sizes typically. VCs will have expectations of the startups as well. So we want to make sure that you're reducing operational costs right now. A big thing is, have you shortened your sales cycle? Like, can you get a customer, can you acquire a customer quicker? And can you reduce those costs? And reducing operational costs, let's pop back up to that one. 3 months ago, 6 months ago, salaries were fat, right? Because the market was doing well, so it was, everything was getting paid more. You could, if you wanted to poach someone from company A or B, you bring them over, you give them a fat salary options, whatever you want to do. Now you want truer to book value. So now you're going to get people, this sounds horrible, but you're going to get people, bring someone on who's a stud at cheaper if they're laid off or whatever, they're looking for another opportunity. You can get them at a truer to book. It's not like it's a cheaper salary, but it's truer to book value. We inflated salaries before, and now it comes. That's what the market does, right? We know that. We've been through that. Miscellaneous, raising cap is an ongoing process. Where are we going with this? Okay, cool. All right. So just the venture capital space, it's 2% of all investments, roughly 3,000 in a given year. Angel investing is 70,000. There's 70,000 deals. They're much smaller check sizes. The reason great companies get money in a downturn, if you're launching right now, let's say, or you're a company that has some success in it and your competition is falling off, your company, you're getting your company to remain relevant in this economic environment. You're reducing your competition is lower. You're leaner, probably. You're learning to perform at a more efficient pace. Your talent is cheaper, as we alluded to. Series A. So usually when you launch a startup, right? We call it seed investing or whatever. It starts at angel, friends and family is angel, and then goes up to VC. We're going to get into this in another slide, and we move up from there. If you're then going to be ready about a year and a half down the road to raise another round when you're ready to expand and scale. So we call that like usually around the Series A. So then, by then, most typical recessions last around that long. So by that time, you'll be on the ground running, killing it. So Uber, who else was launched? Maybe Airbnb, but a lot of them were launched during the last financial crisis, 2008, 2009. And it's just because they were able to compete better than their peers. And they stuck around and they were able to develop the right relationships. And we can go, this may not be as relevant right now. So Tesla's $2 billion raise. Well, if someone wants to ask about that in the questions, we could do that. Okay. I've never done any of these, I'll be honest. Maybe, so 5 ways to raise money for a startup right now. And they're increasing risk of interest, right? So as you go down this, it gets more risky. And then we're going to get into, which is my world, the VC world at the tail end here. So you have to have a vetted business plan first, right? Before you mess with any of these. So I'll be honest, 1 through, maybe I've done 1, I don't think so, but 1 through 5, that's where I'm at. I've never done any of these, to be honest with you, but I've heard of people having tremendous success with them. I've also heard of people not having success with them. So you want to be very careful, right? So friends and family, crowdfunding, your family's, if you have a great business plan, pitch it to your friends and family. Hopefully they'll invest, right? And then you have to do that in a proper legal structure. Say, if you give me so and such amount at this time, then I'll repay it as, in the whenever. You set those terms, and then at this interest clip, if you want to do that, however you work it out with them, set it legally. So then if anyone looks at it, IRS, league, you're covered, right? You don't want to do anything hodgepodgey. HELOC is a home equity line of credit. It's 2 to 5%. So it's basically against your current mortgage rate if you want to do that. So that's, you could do that. Rob's 401k is a rollover business savings thing, and Borsa is another thing, business owners. So these are all funded by our 401k. So essentially how they work, you have a 401k, and I'll put the caveat out here. This is generally done by folks who are older. Maybe they've retired, they have a sizable 401k. They want to take maybe 5% of that and invest in a business that they want to launch for the second phase career. It can be done by younger folks as well. So as these last two, what they are is you take your current retirement account and you set up a separate company. Let's call it company C Corp, and then you fund a retirement, a separate 401k with money from this one, right? So you bring it over here, and then that pays everything and invests in your company. So it's tax-free if you do it properly, and you're following all the covenants, and then you can invest in your company. I don't suggest doing this unless you really, really are tapped out and know what you're doing. But these are resources out there. I'm just showing you cheaper options than coming to a guy like me who's in the VC space, because it gets expensive, right? It sounds counterintuitive, but I want you to be a success, not for us to fleece you for money. You can go to incubators and accelerators. Y Combinator is a good one. There are a lot of these around, and they'll often, they'll vet your business plan, which is a great way to see if you have something that's tangible for the market. And they'll see, hey, is this person, I want them to be part of this cohort. Let's take 10, 20, whatever companies, and they'll be with us for 2-3 months. And then we'll invest X amount at the end of these 10, 12 weeks. There are a lot of those out there. You can check it too. I'm sure you know of a lot of them. Credit card. I have an example of a friend. So someone I know, this is not smart. It's not a great idea, but it's at an 18% clip, which is, if you look at angel investment, 25%. It's in VC, it's 25 to 30%. So it's cheaper than that, but still expensive. I know someone that basically went into $250,000 in credit card debt, and then sold their company to a French company that operates in the US, and they at 250 million, right? So she did well, right? So, but she's an exception, A, B, but she had a phenomenal business model that hit the right timing. It was in the baby food space. And that's, there are examples like that. Investors private. So angel investments are basically someone who has a net worth of 1-2 million, whatever it is, and they'll invest, but they'll take a high equity portion. So let's say they give you, they're usually, if you're a startup and you have an idea that's probably tangible and you want to build a prototype, or you want to get it to the next phase, maybe some marketing growth, you take money from an angel investor, you work out a contract with them, or you get set your terms, a term sheet, and then, but they may take up to 30%. The reason they have to take a larger amount than the VC world generally is because you're taking a large chunk of their personal net worth. So if they have 200, let's say 300, let's say $500,000 to invest, and you're taking, 50,000 of that, you're taking 10% of what they have to invest. And that's a lot, right? Whereas a venture fund, there might be a pool of investors, and it's easier to write a $50,000 check. VC world will take, roughly 25%. It teeters up and down from there. It depends on how you set the terms. It'll be 25% plus an equity stake, and there'll be shares in your company. Then whoever comes on will get shares and all that. It gets all that, runs into other things. Pause. I could pause for a second. I talk fast. I know I talk fast. So if I'm glossing over anything, you can even slow down. Ready? Is there anything?
Let me see. Is anybody have any questions?
Slow down.
On this part? Let me see. I don't see anybody's hand raised. I don't see any questions.
Okay.
Mm-hmm.
Okay. All right. So quickly, do you want to do this and then be a $50 million? Or do you want to do, is there something else? I mean, let's go here, get your questions ready. We could pop in. I'll ask you after this slide if you want to jump to something else, right? You want to, let me go here. All right. How do you become appealing to investors? And then I can show you how we set up our models to show you how you can fit into that appeal. Okay, so your startup, is it appealing to investors? We invest in you versus the idea, because often your idea pivots. So you have this idea, you come on with certain relationships in that space, and we say, hey, this would fit the market better, and we usually move on. But we want to look at someone who has a tenacity to kind of plow through anything and everything. It's vested, put their own money in, even, or their beyond sweat equity, sometimes sweat equity, and see if we can launch you somewhere else. Is it a venture backable business? I had where I saw Alana at this other thing in February, someone had a great question. Why isn't every company venture backable? We need to know, and you'll see this on the previous two slides when I go back to them. can we make a 20x return on your company? If we can't, if we don't see it, we're not going to be able to get down with you for the most part. You may have to go somewhere else is what we're getting at. So opportunity costs of startup job versus a corporate job. You should look at that. Does it make more sense for you to go into a corporate job or having a startup job, right? And then you should feel it out. We also want to see from an investment standpoint, are you operating in a high cost center? If you don't need to be in New York, Silicon Valley, even Chicago, if you can be like St. Louis or somewhere and have access to remote talent or local talent and you can thrive, we would love to see that, right? You do want to be near occasionally where you invest, but if we can see if you can be out of here, because talent costs, operations just a lot higher in these high cost centers. Burn rate, are you plowing through your money? Are you safe with your money? I'll give you an example. Someone came to me, and my buddies Clyde and Anthony know this, and I said on the pod, someone came up to me in a fur coat and was asking me for our company for money. And he was trying to sell me an idea that it's not even in my lane. I'm sports and entertainment and media is where we invest. The fur coat, he's trying to sell me something in consumer goods. His coat costs more than my whole outfit. So I should be asking him for money. So so don't show up like, just make smart choices, right? All right, so own as much of your startup as possible if you can, right? If you can, instead of growing a company to $10 million and only owning 10% of it, and then you have 1 million, let's just say, or if you get your company to 5 million and you own 80% of it, you have 4 million. Right, so own as much of your company. You don't have to always be the moonshot company. You don't need to. There's only room for a few Googles, Facebooks, Apples, Amazons. They all started in a warehouse or they all started in garages, whatever they did. But there's only room for a few of those. You don't need to be that. If you can make more money being at a smaller space, then hopefully get acquired by them, or at least meet your lane and stay in your niche. Do it. That's a great idea. Our VC lives, 99% of our day is saying no because we can't. As I'll show you in a little bit, get behind every deal. And we see that, excellent employees versus average is usually 1 to 3. When everyone thinks that, hey, I have 10 awesome employees, we get in, there's probably like 2 or 3 often. And we want to see that you have the hustle factor. Okay. Oh, so you let me know. Do you want me to go through this or is this going to be boring? You tell me, Radia.
Mia had a quick question, and let's just see. Mia, are you able to unmute yourself? If not, I will.
Mia, is this Mia again? She had a good question earlier.
This is Mia. Okay, let me get to Mia.
Oh, here you popped up. Hey, Mia.
Hey, everybody. I have a question. It's a little bit, it's on subject, but a little bit off in terms of angel investing. So
Okay.
I have a tech startup that I'm working on, but it's not in the US. And I'm working on getting funding, but I'm getting offers outside of the US here in the country that I'm in. Do you think it's wise that I try to get funding where I am, or should I stick to getting funding for my business because I'm an American?
No, I get it.
Right now, so I guess let me just break it down a little bit. The business is catered to a very, very specific market that's not in the United States. However, they feel that it can go global. So it could be a US market later. So should I pursue, or do you think that I should pursue an angel investor in the States or focus on?
So do you already have a relationship with someone overseas? Do you have a relationship with someone who's willing to invest in your company right now?
Yes.
Okay, and I don't know if you want to put this out there, but do you trust that person?
Yes, I do.
Oh, all right.
I guess I'm trying to figure out, I guess, with tax purposes what would be the smartest way to deal with, having a startup that's not in the country, but maybe later.
Okay, so there's a lot, we can peel back. There's a lot of layers to that. So that's a good question. So can you get overseas investors? Absolutely. You want to make sure that you can trust them, and there are rules in place. So I know there are a lot of horror stories with that too, right? So someone from Asia investing here, with someone here. It's not like it just US gets screwed in this deal. It could be other people anywhere in the world getting screwed by the US as well, like US centric Asian investors. So this is commoditized across the world.
Mhm.
If you trust this person and you know they're good for their word, and you could set a contract with them that you know is defensible in court, that's a lot I just said there, then you can proceed. So here's the thing. I know in a lot of countries, and I won't name them because I'll probably get arrested, but you can, if you set up contracts don't really mean anything. So I've invested overseas 3 times, 4 times, something like that. 2 of them I lost for sure. One of them has done well, right? So we're good. But we couldn't defend it. We couldn't take anyone to court on one of them because, hey, that's not how it's done there, right? So we don't need to get into where you're thinking, but we can talk offline if you like. But like, yeah, so you can, but just know that you have to be able to, it sounds horrible. Even if you have a great relationship with this person, you want to know that's defensible in court, and it can actually, people will abide by the law there. And then you can actually have all your covenants, which means basically rules in place to protect both you and them. Does that answer your question? I can't go into details without knowing too much about your business. And we can do that offline if you like.
Yeah, that'll be good. And yes, that was helpful.
Okay.
Would like to chat offline as well.
Okay.
Thanks, Mia.
Thank you. Thanks, guys.
Okay, Crystal has a question. Crystal, can you unmute yourself, or do you need me to unmute you? Let's see.
Can you hear me?
Yep.
Yeah.
Awesome. Thank you so much for this excellent information, Atul. It's really informative. I just have a question about, well, it's a 2-part question. So one is, when you're talking about proof of profitability, when you're pitching, about how long do you want to see? I've heard anywhere from about a year worth of profits that make investors excited. So about how long should I be out there in the world, like selling the product first? And then when do you make that decision on if you should even really go with an investor or not, right? Meaning if the product is making money and you see that if it's going to continue to scale upward, but you know you might need some additional resources, when do you make that decision to bring on an investor or choose to just continue to do your business?
So great question, right? So there are a lot of, again, layers in here. So great question, Crystal. So first I would say, if you never need to take money from an investor, this can sound counterintuitive, don't take it, because it's expensive. You see what we charge, right? Right. But it's only worth, you don't want to take, and also you want to take smart money. Let's put it on a positive spin. You want to take smart money. Let's say you're in fashion and you know someone who's killed it in the fashion space or has distribution channels or whatever it is, and they want to invest in your company because then they can take you to their market and then help you sell and grow scale. That's smart money, right? So then the second part of your question is, how long do they want to see? So that's industry specific. So let's go to fashion again. Fast fashion is a thing. I think fast fashion actually is it's teetering down now. It's got Zara and the H&Ms of the world. They've gotten beaten up, right? Because I think there's a lot of things happening in the market shift. There's paradigm shifts. So they did well for a long time and now they're getting beat up quite a bit. If you're there, they're going to look at a shorter life cycle. If you're in healthcare, we know that if you're going to launch like the next COVID, right, cure or whatever it is, that's a long life cycle. Right. So you can't show us 12 months in that. And you have to show us, hey, it's going to be 2, 3, 4, 5 years before I make any money on this. Right. So it depends on what industry you're in as far as how many months and years of profit or revenue you need to show. We want to see that you have good product, fits the market, people want it, and you're growing like crazy and you're efficient. I can't answer more without knowing more about the business because it is very interesting. You could say it here if Radia gives us time, or I can talk to you offline, however you want. But it's a great question though, but it's very industry specific.
Yes, thank you. I don't know, Radia, do I have time for another part to that question?
Sure.
Okay.
Cool.
And so then my last question, which you probably will say I can't answer this online.
I'm just leaving right now.
So if you're creating a product that like you're currently employed and you're creating a product that could be sensed as a competitive product to where you actually are employed, how do you go about that, launching that product, I guess, under the radar?
Okay, so I'm assuming you have to be the face of it. If you have to be the face of it, then somebody's going to find out sooner or later. And this happens all the time. There are many case studies. You can just kind of just Google this and you'll see a lot without me mentioning names, because a lot of you are probably at those companies that I'm talking about, but you can see those names. This happens all the time. And what you don't want to see is, what's a company I could take that's outside of the realm of who our folks are here? Car industry, right? Okay, you have a new concept for a electric car, but if you're working at Tesla, they may say you were taking your ideas and then just trying to spinning it off and calling it your own, right? You want to be able to show that there's no conflict where you're at. But at some point, unless you can run it without being the face of it. Usually when we see smaller companies, we want to see someone take ownership and be the face of it, because that's who you always point to and to help drive the business. And I'm answering vaguely again because I don't know the specifics. And I don't want to. That's as far as I can go probably right now without knowing more about it. But,
No, that was very helpful.
Yeah, well, okay, yeah. Is this Crystal? Do I know you? Are you from Atlanta?
No, I'm not from Atlanta, even though I sound a little country, but
Right.
I believe that Radia has worked to connect us in the past, but I definitely would love to chat offline for sure.
Absolutely.
And then Elle has a question. She said, can you share a good resource to consult as you are building your business plan?
Let me understand the question. Can you share the resource to build as your
a good resource?
Oh,
consult as you build your business plan.
So you're saying like a tech developer? Is that what you mean?
Let me see if Elle is still on. I can ask her.
I'm writing this down. Just so I understand the question, because
Elle, you can go ahead and ask your question. Just unmute yourself.
Hi, yeah. Can you guys hear me?
Yep.
Okay. Sorry if that wasn't clear. I was just curious, we talked about vetting your business plan. I'm super curious about the space and I would like to start, but what can I consult to kind of make sure I have a good business plan?
Got it. So you want to see if you have a good business plan in place. You should speak to people in that space.
Okay.
And then speak to investors in that space, see if they'd even be interested in it a while down. And don't worry about like the NDA things. We all think that's BS on our side. I've talked about this all over the place. Nobody's going to steal your idea. No one has time, right? They want to get behind. So you can speak to people who are experts or high profile folks in the space. That's a very vague answer. Mm-hmm. You want to dig further? What are you looking for?
Is there any way to look to see where's good, a good makeup of a business plan?
Yeah.
What makes a good business plan?
What industry are you in? What industry are you thinking about?
I have all these ideas. Example, how about just buy and sell? If I see a lot of products out there that I think will be good for a different market, and if I can bring it to that market, what about that? Something like that, should I just start? Don't even worry about a business plan?
No, you should always have a business plan.
Okay.
It would just be helpful, because then you can rely on it saying at some point at month X, if you're still going down, your revenues aren't exceeding costs yet. So you want to know what your next move should be, right? And is it worth staying in? Because here's what I advise people. If you can leave your corporate job, if you feel like this company, if you can make $200,000 a year in a corporate job for 10 years, that's $2 million. Let's just say a simple number, right? But if you can, if in 2 years you can get $2 million at a startup, then take it. Most of you won't. Most people don't, right? 95 or whatever is 80% fail. So you want to make sure that you have a viable business plan that can actually catch on with people. Where is a good resource for you? Looks like you're thinking about buying things overseas and selling them here at a higher price, at a higher margin. Is that what you're looking at?
Yeah.
Okay.
I don't feel like it's someone's actively bringing that to this market.
That's happening a lot though, right? Isn't that what Pier 1 Imports? I mean, they're a crappy company. Sorry, I shouldn't say that, but they're going down. But they're going down. They're filing for bankruptcy, but that's exactly what they did. Or so ABC Carpets, right? Let's take this. I know someone in the rug business, and I was talking to them. Same exact carpet, they would sell it at a higher margin profit at a higher price point to ABC Carpets, which is a higher profile here in New York City. It's that really nice mega store in the Union Square area, and then they would sell at a different price point to some other people. So that's happening a lot here on every level.
Mm-hmm. Yeah.
So, go ahead.
Well, what about just some items that I see? I feel like if this could be blown up, then we can make some money. but yeah, I guess I kind of want to do that business. Even though I guess the bigger companies are not having success with it.
But, okay, there are a lot of companies having tremendous success with this kind of model, like buying overseas and selling here.
You said that it was going down.
So the fast fashion that you're talking about, H&M, Zara models.
Oh, okay, like the Pier 1 and the
Pier 1's,
yeah.
yeah, done. I mean, they filed for bankruptcy. I mean, they could relaunch as another brand. It's, you know, the thing is, they're around, I think, right now. They're still closing down a lot of their stores, but they need to, their inventory will just get bought out, and that's what's happening to them, right?
Okay.
But that plays. So, hey, I'm from South Asia. I've seen an ABC Carpets, a door that was in my homie's house in like India somewhere, in Cousin, and it's like a broken ratty door. They break it off, they put some paint on it. They're selling it here for like 10K. My wife and I looked at it like, what the hell? But that's what happens, right? That's what ABC Carpets, that was our model, right? So, and this is my cousin's got this, and he's trying to replace it back in India, right? So, it's a beautiful country. I'm not knocking it. I'm just saying that's what they do. They kind of drive up the margins here in a different market, right? So there is a market for it. You just have to make sure that you have to get the goods over here if you're getting produced overseas, and then inventory, you have to hold it here and cash it. So, you know, I'll be honest with you. Remember when, just last week, and I looked into this, and then I quickly, within 3 minutes, knew I wasn't the right person for this. So oil, they said it was at negative rates, right? Oil, so then they're basically, oil per barrel was at a low rate. So you could actually buy, you could get them at pretty cheap, but you have to buy 1,000 barrels of oil at a time if you're going to be, so you can be like a true buyer. I had nowhere to store that, A, B, or move it. So I quickly got out of that discussion. I thought if it's at cheap rates, oil's going to come up again. I could make a killing, right? But I'm not the right guy for that. I saw. So just, you want to know that you have a market and you can store it. I mean, you know all those answers around it. And, you know, there's a lot to be discussed. So we can chat on this offline, just so I'm not taking up everyone's time. Sorry if I didn't even answer your question properly.
Yeah. No worries. Thank you so much.
Yeah.
Yeah, and guys, we will send you an email with Atul's information, his suggestions, ways that you could reach him, speak to him. So I know we have like so many questions. We only have a couple more minutes, Atul. I don't know if you have more slides you wanted to run through really quick.
No, I mean, this, you know, the questions are probably more helpful. So let's do that. Yeah. And I'm happy. I love naming New York, so I'm good with you. Just stay on for a couple more minutes. Cool.
I'm happy that you're not tired of us. Yeah.
It's a smile. Even Carvel's smile. That's what got me.
Okay, let me see here. So someone recommended a book.
Okay, I'm gonna write it down too.
Business Model Generation, strategizer.com. Business Book Generation. And I dropped that in the comments for you guys to see.
There's a ton of books from highbrow to lowbrow. What I mean by lowbrow is there's one, How to Invest in Venture If You Have No Capital. And I was like, what the hell is this guy talking about? I saw his Barnes & Noble about my kids, and I saw it. I was like, what is this guy talking about? I looked through it. I'm like, oh, this guy's interesting. I'll never do any of this stuff, but he has an interesting for someone who's younger and has maybe the appetite for that. He's doing some interesting things. I have the book sitting straight across there. I have you facing on this side of my wall so you don't see all the junk on the other side.
Jolene said for business plans in general, New York Public Library has a lot of great plans. Also Science, Industry, and Business Library has resources. Thank you, Jolene, for that tip. And let me see what else.
Absolutely.
Do we have any more questions? I'm just going through this. We have 2 chats open. Let's see over here. A good result. That was the other one about the business plan. I'm reading from 2 different chats, Atul, so bear with me. I'm going back and forth to make sure. In the meanwhile, do you know of any apps? Do you use any apps when you're investing?
No, I go straight on. I mean, I have E-Trade and Fidelity and another one, but I just go straight online. I mean, the app isn't as robust for me. So the apps, you can do it all online, right? So the apps, you want to be able to see as much information as possible so you can make the right choice, right? So wherever if you feel comfortable doing it here, I never liked E-Trade on the iPhone. I just never did. I just don't like it, but I love it on online. I'm comfortable with it. Fidelity, I'm comfortable with. Scottrade, I used to be comfortable with too. I haven't had it in a while. So all of those companies I just mentioned have apps, so you can look at them.
Mhm.
Now, if you're looking at for informational driven apps, I can look at those. So here's what I do, and you can't trade from them, but I read Bloomberg all the time, the free version, because it's costly. There's a CNBC app. What else do I read? I listen to a ton of podcasts, just because of my attention span. I'll be honest with you. I can listen to a book or listen to somebody speaking more than, and I'll absorb more than actually reading it. It's always been my thing. There's 98% of the people are the other way. They could read it and capture it better. What else? I'm just looking at my phone right now. Keep asking me questions. I'll tell you what I have here.
Mia says, Atul, loved your startup pitch competition at NAMIC Conference 2019. It inspired me to act. Oops, we have some other questions coming in. So it inspired me to act on my startup idea and find the confidence to get going.
I love hearing that. That's great. That's great. And we're going to hopefully, we're signed up to do it this year, October 3rd, or I think 2nd, as long as everything's flying this fall. Let's see. And Mia, so just to piggyback on that, we, through Cyber 360 Ventures or through Whiskey Hue, which is right on your screen right now, we do a lot of, we were supposed to have some events in April. We were partnering with Digital Diversity Network and we were going to do like a little startup showcase and a little mini conference, like a half day type thing. So as soon as we had something scheduled at S&P in Hudson Yards, SAP Innovation Lab, but we had to postpone everything, just like NAMIC's doing this way. So we will have those and do those in the future. So stay in touch with us. You can sign up on Cyber 360 right here. And there's a tab up at the top right-hand corner, like right around here on that website. And then you can just submit and we can get you in one of these, if it makes sense.
Yeah, and I was going to say, could you quickly tell us about Whiskey Hue? Because we're going to continue the conversation on Thursday with the Whiskey Hue podcast. So if you could tell us a little bit about Whiskey Hue.
Yep. So here's us three. We're all NAMIC New Yorkers, right? So here's Anthony, Clyde, and there's me over here. And we talk venture, tech, and culture. And we pour up every episode. So we call it whiskey, so we're all Scotch whiskey fans. And we literally get a new bottle every time and we talk about it. And then we talk about investing, what's happening between Amazon, Walmart, what's going on long form here. We're talking about esports. We talk about everything. And Clyde, Anthony, and I will be on Thursday. We'll do a similar session, but it'll be more fun because we're gonna be pouring up. and then, like I had to keep this kind of highbrow for this one because it's finance related. That will be everything. We're actually gonna walk you through ideation of a startup through IPO, because Clyde's actually been through an IPO, and I'm in the space and I haven't actually. we've tried to, he's the cool one. But so we're going to walk you through that entire spectrum. So what happens? Business development, marketing, ideation, getting the right team in place, investment, all of that, and then taking it to market, and then IPOing eventually after market, after successful. So we're going to walk you through that entire thing. So we do that every week on our show. So we're on a podcast, Whiskey Hue. Look us up. Here's the Apple. We're on every platform. We do it weekly. We have about 15 episodes, and it's dope. It's just we're three guys. We enjoy each other's company, and we have fun talking about different topics. And it's all tech, entertainment, culture. Like we talk about the business models behind all of these different things. So that's that. So you'll see us Thursday, 1 to 2 o'clock again that day. I'm launching another podcast, which is U.S. and Asian business centric. So, and that's coming soon. So that'll be a deeper dive into finance. Here we keep it's deep. We go anywhere from 101 to 401 level, but we have fun here and it's a fun time. We're going to be doing a lot of live events as we can again. We had to, as I mentioned, postpone one from April, but it's going to be fun. It's a good group. We have a good conversation. So Clyde is he's the marketing sales expert. Anthony's the business development expert, and he knows affiliate sales and all that. And then I'm the venture media guy, and we just have our paths, how they cross around certain topics. It's a good time. Listen to us.
Good time. Yes. Carvel and I will be popping in saying saying our piece on Thursday.
Yeah,
I don't know what we're going to be talking about, but we're looking forward to it. It's going to be fun. So I have one more question for you, and then I guess we'll wrap it up because we are closing in on time now.
Okay. Yeah.
For entertainment media projects or series, angel investors or traditional investors are often averse because they don't understand the creative industries. But people are finding investors shooting a whole show and then selling it to Netflix, for example. Do you have any tips for something like that?
So it's a hard thing, right? So now, so there's two sides to this, right? So it's true what you said. So that's why you want to find smart money, people who know this space well. You want to know people who have been maybe executives at like the Comcast or Disney's or whatever they are, and then now they're popping into this space. That's the first part. So you can find smart money, which I mean, they know the space well and they know how to grow and scale something. Now, selling to Netflix, yes, that's absolutely happening. I think the next 5 to 6 years, we've been saying this for a year, even on the Whiskey Who podcast, we were saying it. So the next 5, 6 years is going to be, in a good way, a bloodbath. Everyone's in it. Everyone's doing the digital streaming thing. And Comcast is getting in because they want us tethered to the linear version still, right? They're offering their app, but Disney, obviously Netflix is in there. And Netflix is we're looking at that same place. The whole reason we were launching this next fund was to develop content to stream, to license to these streaming services, right? That was one play. And next 5 years, there's going to be a ton of money from all of those folks ready because they want content, because they want all of us, our eyeballs on their streaming service. So they're going to be competing. So they're going to be paying up the wazoo for the next 2 to 3 to 5 years. I think it's going to settle down after that. So you see like the B grade, C grade actor getting starting roles, they're like the starter on the team, on the A team, just because they need so much content. So everyone's employed. I mean, in a typical, outside of this current market right now, because everything happening. So there'll be a ton of money. And I see when everything resumes again, because you're going to have that money still pouring because they want content. Apple's got a surface, Netflix, Hulu, which is owned by Disney now, majority Disney, Comcast, they all want their things. Viacom has a service coming out. At some point, there's going to be too much content for us to absorb. We can't physically absorb all this, all of us, right? So then it's going to fall off. And that'll be the next big thing. But I think the next 3 to 5 years, you have a play. If you have good quality content, create it. But so I was shopping something to a company that I won't say the name because some of you are probably from there. They're great. They explain the entire model, how it works. And it didn't end up going forward. And what they do, they'll come in with half the money, we come in with half the money, and then they own the rights to it for like a year and a half. And I'm sure a lot of you know this. And then after that year and a half, it comes back to us, the creator, and then we get to promote it however we want. So those are the kind of business models that are out there. So check out the different business models per company and then per service right now. So a lot of you may be from the big conglomerates, but then there are these other players that are kind of making a steady play. Who's going to survive and all that is a nice question, right? 10 years from now, 15 years from now. So that's a long, long way to answer your question. I'm sorry, whoever you were. That's what I do though. You there?
There's some strange construction going on all of a sudden they want to do, and I kind of muted myself, but good stuff, good stuff, good stuff. Let me see, I think we have one more question. We have one more question. I'm a student, I'm very new to this. This is from Paul. I'm very new to this whole investing thing. It's very overwhelming. How would you suggest I get started? Just like what's the very first thing just to get started?
Who's this again? Who's asking this?
Paul.
So if you're so here's one simple thing. If you like technology, or if you like cars, or if you like whatever you like to do in your downtime when you're not at work, read up on it. And then you read up on it, and then you see the top 2-3 companies in that space. And then you say, well, how do I play? So what happens? And then you start take 1 or 2 of those companies and look at their stock price and see how it reacts to the overall market and everything else going on with all the news that's happening. That's the best way, because you're going to have, because if you ask me to read about an industry that I don't really care for, I'm not going to do it on a daily basis. Tech, finance, media, I love reading about it. So I'm in it multiple times a day and I'm absorbing as much as I want. So that's going to be your best success strategy, because then you'll know everything and anything and everything about the market. That's the best way I would go about doing it.
Wonderful. Thank you. Thanks so much, Atul. We really, really appreciate you taking the time out. You gave us a lot of information. People are really interested in this, and this is something that I think is really needed. We don't know what to do, where to go, how to start. So this was a great foundation, and I hope that we can build, off of this with you and continue on with these conversations. Everyone is just writing now saying this was really great. This is amazing information. Thank you so much. And again, we'll follow up with everyone. Atul, I'll get with you in a little while, and then I'll give you all the information so you can send out some information to all of these great attendees. Everyone, please remain safe, sound, healthy. I look forward to seeing everyone in person, but until then, please continue to follow us on these webinars. We have many different topics that we're covering. On Thursday, we're going to be with Atul and his crew on the Whiskey Hue podcast. That's going to be on Thursday at 1 o'clock. You can sign up in Eventbrite through our Instagram. We have the link there. And then we have some great webinars coming up. Our Millennial Committee is putting on a webinar with the HR talent acquisition of Viacom CBS. They're going to be talking about job searching during this quarantine pandemic, how to interview, how to be smart about your job search. So that's going to be some great, great information. We're looking forward to that. So we have a lot of stuff coming up. We have an event at the end of the month. I just want to quickly mention it is Asian Pacific Heritage Month. We are going to be doing a great panel. And we're putting that together for you now. That's going to be at the end of the month. So stay tuned for that. Thank you, everyone. Be safe. Have a good day at work or a good day at home, whatever you're doing. And we will connect soon. Thanks, Atul.
Thank you. Hopefully it was helpful. And someday you're gonna learn my name. That's cool. We can do that offline. All right. Thank you so much.
Take
Hopefully it's
care,
helpful.
everyone. Bye.